Okay, let's get started with the introduction to Chapter 25. In this chapter, we're going to talk about measuring the aggregate economy, or in other words, national income accounting. Now, this isn't the most, what's the right word, exciting of all topics in macroeconomics, but it's a really important one because this is the basis of where we get our data, how we actually measure our data in order to analyze how the macro economy works. So let's get started. At the end of this chapter, you should be able to define GDP and identify these four main components of GDP. Calculate GDP in a simple example, and distinguish between net and gross. We'll talk a little bit about the difference between gross national product, gross domestic product, but to be honest, that's kind of an old topic. List four components of aggregate income and explain how profit is key to equality between aggregate income and aggregate production. And we'll distinguish between real and nominal. We talked about the concept of real and nominal last time. Now we're going to really apply it. So we talked about that in Chapter 24. We'll apply it now in Chapter 25. And discuss some of the shortcomings of using GDP. All right, so let's get started. Aggregate accounting, all right, or national income accounting is the kind of the more traditional term for this, is a set of rules and definitions for measuring economic activity in the aggregate economy. That is, in the economy as a whole. So when we want to know how much overall does the United States of America's economy produce, that's what we're talking about in this aggregate accounting. Or how much does the European Union produce as a whole? All right, that aggregation is what we're talking about within this section. Aggregate accounting is a way of measuring total or aggregate production. But we have to be careful because, well, let's say we produce 50 iPads, 40 laptops, and 10 rolls of toilet paper. Well, 50 plus 40 plus 10 equals 100, right? Well, but toilet paper is not worth the same as a laptop, and a laptop's not worth the same as an iPad. We have to have some way to, well, literally compare apples and oranges. So, gross domestic product. This is an important definition. I want you to remember this. All right? Gross domestic product, GDP, is the total market value of all final goods and services produced in an economy in a given period. All right, so if we have annual GDP, then it'll be 1 year. If we have quarterly GDP, it'd be 1 quarter. All right, it's the total market value. How do we determine value of a good? Well, what does it sell for in the market? And we only focus on final goods. Now, notice it says goods and services here. That's really just for clarification. A service is a good. A good is anything that can provide utility. Utility is the power of a good to satisfy a need and or a want. So services are definitely what we call goods. So final goods produced in the economy. So there's several points to this that are important. So market value lets us compare apples and oranges. Final goods helps us avoid double counting, which we'll talk about a little bit later. Produced in an economy. Now the difference between gross national product, gross domestic product will be how we define an economy in a given time period. So, calculating GDP requires adding together millions of different services and products. All of the quantities of goods and services produced are multiplied by their market price, that gives us the market value, to determine a value measure of the good and service, so that we can measure everything in terms of dollars, so that we have a standard unit of account. This is weighting the importance of each good by its price. Indeed. Each unit of the good by its price. The sum of all these values is GDP. Okay, GDP is divided into four major expenditure categories. Consumption. This is household spending. So this is about 70% of GDP, and the overall purpose of our economy is to create stuff that we can consume. So this is stuff for final consumption. Investment, this is spending by businesses on goods that they use to produce other goods. So for example, if I'm a trucking company and I buy a truck, that's considered investment. Now, investment is not the same as what we use in, say, a finance class or in general usage of the word. So like, for example, buying a stock, all right, a share of stock on the stock market would not be considered investment in this sense of the word investment, all right, because that would lead to a kind of double counting. Investment is only buying of stuff that we use to make other stuff. Government spending, so the government spends money, and that we include that in our expenditure. And then net exports, so we have a foreign sector. So if we put this together, we have a household sector, we have a business sector, we have a government sector, and we have a foreign sector. And that basically makes up 4 major parts of our economy. We can break everything else down into one of these 4 different parts. All right, since all production is categorized into one of these 4 divisions, by adding up these 4 categories, we get total production of goods in the U.S. So GDP equals consumption plus investment plus government spending plus net exports. So GDP equals C plus I plus G plus net exports. Now we need to talk a little bit more about net exports. What is this? This is exports minus imports. Now, here's the question. Why do we have to subtract off imports? Well, it's simple. Imports aren't produced in the United States. So, they're imported to our economy, so we don't want to count that as production within our economy. So we want to subtract those off. More than that, it would lead to double counting if we didn't. So, for example, let's say we import a bottle of French wine. So French wine actually should go in France's GDP, or also in the European Union, since France is a part of the European Union, in that GDP. All right, but where is it going to show up? If I import that French wine, it's going to show up in my consumption because I bought it. All right, so I'll have consumer expenditure of, I don't know, say $50 on a bottle of French wine. Well, that's not a part of the United States GDP, so we want to get rid of that. So we're going to subtract it off here. Okay. So, expenditure breakdown. Let's take a look. In the U.S., about 71% of our GDP is made up of consumption, which makes sense because that is, by and large, the main point of producing within an economy is to create consumables. Investment makes about 14. Government spending is about 20. Exports are about 13, and imports are negative 20%. So we have a trade imbalance. We import more than we export. And since imports are being subtracted, that's why it's negative. Okay, but as opposed to, say, Belgium, who almost 89% of their stuff is exports. Actually, I'm sorry. These aren't percentages. They are, what are, oh yeah, they are percentages. Goodness gracious. Ah, yeah, because they export slightly more than they import, but their net exports, their foreign sector of their economy, is gigantic relative to their actual production within economy, which makes sense because Belgium is pretty small. Czech Republic, you got something similar. Germany, you can see they have a slightly positive trade balance. And all of these countries consume slightly lower percentage of their GDP than do the United States. And they invest a slightly higher percentage of their GDP than the United States. And their government spending is a little bit less too.